Recession predictions is something that we've gotten used to seeing very frequently in the news over the last couple of years. In fact, the Federal Reserve Bank of New York has a model that's been predicting a 50% chance of a recession for the past 16 months. This is what their model looks like, and it started to flash a recessionary warning signal in early 2023. And has still been doing so for the past year and a half. In the past, their model has worked pretty well at anticipating pretty much every single recession since 1960. In fact, many of Wall Street's most reputable investment strategists like Mike Wilson and Marko Kolanovic have also been wrongly calling for a recession to materialize in the United States during this time, with some getting outright fired for having failed to anticipate the massive bull market we've seen on US stocks over this time period. And believe it or not, the United States government is likely very much responsible for the US economy so far being able to avoid a recession. We ourselves have also been expecting a recession to materialize sometime in 2024, and clearly that hasn't happened yet. In fact, our price signals today still suggest that the US stock market could continue moving higher over the next few months. The same price signals that have kept us bullish on the stock market throughout 2024 and enabled us to make incredible trades. So the question of whether we should be sticking to our recession call for 2024 or even 2025 for that matter is really coming into question. Is it possible that government spending has been able to push out the next recession by multiple years? In order to answer that, we need to look at exactly why so many intelligent people have been calling for a recession in the first place. The easiest answer can be found on this chart right here, which represents the interest rate of the Federal Reserve, the central bank of the United States that controls interest rates. And over the last couple of years, they raised interest rates from 0% to 5% in a very rapid way. Pretty much every single time that they've done something like this, an economic recession followed. The easiest way to classify what a recession is simply by looking at unemployment in the United States. Every time a recession occurs, the United States unemployment rate is rising. And you can see if we shift forward interest rates by around a year and a half, they pretty much exactly predict what the unemployment rate is going to do in the United States. Every time that the Federal Reserve raises interest rates, about 2 years later, you see the unemployment rate in the United States rise as well. Now, there are exceptions like 1984 and 1995, where the Federal Reserve raised interest rates, but the unemployment rate kept on moving lower in both of these instances. But you can already understand why a lot of people have had a bias towards a weakening economy given this very aggressive rise in interest rates that we've witnessed over the last couple of years. Despite that, for now, the unemployment rate has remained relatively low. It's risen a little bit over the last year, but nowhere close enough to classify this as a recession. In fact, the NBER, the organization that officially classifies recessions in the United States, uses 4 key metrics: unemployment, personal income, which is basically wages, gross domestic product, which is basically the total US economic growth, and industrial production. As of today, the fourth quarter of 2024, none of these are showing recessionary characteristics. Unemployment is still reasonably low, personal income and GDP have both been growing very strongly over the last year, even when adjusted for inflation, and industrial production has been steady. So what on earth is happening here? Well, that's where the US government has been playing a key role in making sure that these numbers continue to remain strong. This is a chart that shows us government spending as a percentage of GDP, so as a percentage of the total US economy, and it's currently at a whopping 23% versus government revenues that are currently at 17% of GDP. So this gap that you see right here, that's called the deficit. And throughout 2023 and 2024, it's represented about 6% of GDP. Now, why do we care about that? Well, high government deficit is basically the government spending money it doesn't have, what many would call money printing. Now, it's not exactly money printing because eventually we're going to need to pay it back, but in the short term, that's basically what it is. And so today, they're effectively printing about 6% of the total US economy each year. So that definitely gives a nice boost to those GDP numbers. But all of this deficit spending is also reflected in the job data because a lot of that government spending is going directly towards creating government jobs. This chart right here shows the number of government jobs being created per month. And indeed, today the government has been hiring about 50,000 workers each month on average for the last 2 years, which is definitely some of the highest levels we've seen over the last 30 years of data. This job creation is definitely helping the job market in the United States stay stronger than it otherwise would be, and we can probably say that it's helping delay the recession as well. However, if we zoom out a little bit further, we see that yes, government job creation is hovering at the highest level since the 1970s, but when we add those NBER recession bars on top of this chart, we also see that high levels of government job creation hasn't stopped recessions from occurring in the past. In fact, arguably, we see the government try to create a lot of jobs before and during most economic downturns. What we're seeing today doesn't seem to be too out of the ordinary. So it doesn't seem like the government has been able to stop recessions from occurring in the past. So the government spending and job creation today are very likely delaying the recessionary process. But we don't believe that it's outright preventing a recession from occurring. For example, small businesses in the United States are clearly showing signs of struggling more and more. This is a chart that shows the percentage of small businesses that are seeing their earnings grow. And it's been steadily weakening throughout 2023, and it's recently dropped off even more aggressively today. This is something that's typically seen in the lead up towards economic downturn, while economic booms in the US are typically accompanied with rising profits for businesses. As is often said, small businesses are the backbone of the US economy. This is absolutely true. Small businesses represent about 99% of all businesses in the United States, and they employ about half of the entire workforce. So seeing small businesses struggling today is a sign that the whole economy is struggling underneath the surface. And the high levels of government spending doesn't really seem to be doing much to solve this. We can also see this by looking at this chart. This is the number of small businesses that are increasing their inventories. And in recent months, that's been declining precipitously. Again, this is something that typically happens heading into or during economic downturn. When small businesses are thriving, they typically increase their inventories substantially in anticipation of strong demand. That's not what we're seeing today. Now, as we mentioned at the beginning of this video, our price signals that we use to guide our trading strategy at Bravos Research are still somehow pointing upwards for the US stock market, which means we continue to use weakness and dips in order to add new trades like we've been doing throughout this entire year. The S&P 500 is still trading within a very strong bullish technical structure that's allowed us to time our entries and exits very nicely. The S&P 500 is still trading within the price channel that we've been looking at over the past few months. This is a very strong technical structure. Now, there's been a little bit of a correction recently with the S&P 500 breaking below this key trend line here. In the short term, that does open up the possibility of seeing a move down to the bottom of this channel. But for now, the research that we're sending out to our clients doesn't suggest that we should be expecting a big breakdown of this channel just yet. Now, we booked profits on quite a few of our trades as the S&P 500 was at resistance, including our ongoing trade on Bitcoin and a trade that we have on a stock called Palo Alto Networks. Both of these are up around 20% since we initiated them. If we do see more volatility on the S&P 500, we'll be using that dip to initiate new trades, as our take for now is that the bull market on stocks can still continue heading into the end of the year. You can see all of our closed trades on our homepage. We've had a spectacular performance since the beginning of the year with over 20 different winning trades that have an average win of over 17%. So that's the equivalent of the S&P 500's return so far in 2024, but 20 times. Of course, there are losing trades, but our goal is to keep those losses very small by cutting our losing trades very quickly. Go to our website and subscribe to our service if you're interested in having access to all of our future trades.